In the world of investing, one of the most common metrics you will run into and hear people discuss is the price to earnings ratio. But what does this ratio tell you? What does it mean and how should you use it? In today's video, we are going to be discussing everything you need to know about the price to earnings ratio because contrary to popular opinion, this is not always the best ratio to use when analyzing and valuing stocks. So let's just dive right into it. And let's start off with what is the price to earnings ratio? The price to earnings ratio is exactly what it sounds like. It is the price to earnings ratio, and it tells you how much a stock is being priced relative to the company's earnings or relative to the amount of earnings that the business behind the stocks generate. For example, we can see here that at the time of recording this, Microsoft has a price to earnings ratio of 25, which means that investors are paying $25 for every $1 of earnings that Microsoft's business generates. We can also see that JP Morgan has a price to earnings ratio of 10, which means that investors are valuing this business's earnings much less than Microsoft's and only paying $10 for every $1 of earnings that JP Morgan generates. The reason for this is because investors are willing to pay higher multiples of earnings for businesses that are growing quickly or are in exciting industries. For example, Tesla, which is one of the fastest growing and most exciting companies in the world, currently has a price to earnings ratio of 52, which is much higher than most stocks trade for in the market. This simply means that investors are willing to pay a higher price of $52 for every $1 of earnings that Tesla's business generates. Now, another way to think about the price to earnings ratio is the demand for the stock. So if the price to earnings ratio is higher, then it means that there's just more investor demand for that business. And then on the contrary, if the price to earnings ratio is lower, then it means that there is much less demand for shares of that business. So again, the price to earnings ratio can also give you an indication of how much actual demand out there is there for the stock that you are taking a look at. The price to earnings ratio also tells you how long it would take for the company to pay you back your entire initial investment based on the company's current earnings. For example, if Tesla is earning, let's just say $100 in earnings, and I pay a 50 price to earnings ratio for this business, then that means that I am paying $5,000 for Tesla's business. And then it would take Tesla 50 years to pay me back all of my money. Whereas JP Morgan would only take 10 years because the business has a much lower price to earnings ratio, which means that investors are buying much more earnings for every dollar they invest in this business. Now, the thing is that businesses do not always pay out all of their earnings as a dividend to their shareholders. The reason for thinking like this and thinking about, okay, if I buy Tesla at a 50 price to earnings ratio is because then you can more rationally try to understand the valuation of that business. You can say, all right, well, at this price, it would take me 50 whole years to get my money back. Then you can sit down and ask yourself if that's the type of return that you want, or if you would much rather be buying a business with a lower price to earnings ratio that is giving you a higher return on your investment. So then the next question is, why would anyone ever consider buying a stock with a higher price to earnings ratio if there's stocks like JP Morgan trading at a 10 price to earnings ratio, giving you a higher and faster return on your investment? Well, it's because a low price to earnings ratio does not always result in a business producing more money for you. And a business with a low price to earnings ratio could have low demand for the stock because the business's fundamentals are declining or the business is losing, revenue and cash flow. And the business is losing business. That's one way that I like to put it. So basically, to summarize everything that I'm trying to say here, a low price to earnings ratio or a high price to earnings ratio does not guarantee that you are going to make money on your investment. As Warren Buffett has historically said, you cannot boil down investing into one number. So you cannot just look at one metric like the price to earnings ratio and say, yep, the price to earnings ratio is low, it's a good investment, or the vice versa, the price to earnings ratio is high. So that must mean that there's a high demand for the stock. That's got to be a good investment. Other investors are interested in it, so I'm going to buy it too. Again, investing is just not that simple, and there's a lot more that goes into it than just looking at one number and making a decision based off that. So then the next question is, so how do you use the price to earnings ratio and when do you actually use it then? Well, one of the most common ways that investors, even myself, what we do is we take a look at the company's historical price to earnings ratio, try and find the average of how the market has valued it over history, and then compare that company's price to earnings ratio throughout history versus how the stock is currently trading. So that may have been kind of confusing. So let's just go do another example here. And we're going to take a look at JP Morgan once again. So right here, we have JP Morgan's price to earnings ratio, and let's take a look over the past decade. So we can see that it's been kind of volatile. It's gone from about 8 to about 16. So the way that the market has valued JP Morgan over the past decade has been, again, kind of volatile. Right now, JP Morgan is valued at a price to earnings ratio of about 10.7 right here. And if we scroll down, we can see that the average over the past decade has been about 10.79 or about 10.8. So JP Morgan's price to earnings ratio today, right now, is almost in line with how it has been valued over the past decade on average. So an investor could look at this right here and say, okay, well, maybe JP Morgan right now, this suggests is selling for about fair value, or it's about in line with how the market has valued this business over the past decade. And it doesn't really look that expensive. And in all honesty, JP Morgan does not look that expensive to me right now. So this is one way that investors use the price to earnings ratio, again, is to take a look at the business's history to see how it has been valued, and then look at how the business is valued today versus the company's history. Now, unfortunately, this does not always work either. And I wish that it would, but again, investing is just not that simple. So what we're going to do now is go and take a look at Berkshire Hathaway. And we're going to take a look at Berkshire Hathaway's price to earnings ratio over the past 5 years. And by the way, Warren Buffett, the best investor who's ever lived, is the CEO of Berkshire Hathaway. So right here on our freeform tool, we can see that Berkshire Hathaway's price to earnings ratio in 2018 was about 8. Then in 2019, it spiked all the way up to 124. Then it was back down to 18. Then it dropped to 6. Then it spiked to 43. Then it was back down to 6. Then it spiked to 55. And currently it is sitting at 0. So whenever I see a price to earnings ratio like this, it's really hard to draw conclusions. And honestly, I don't like to draw any conclusions from a chart like this. This is too volatile of a price to earnings ratio. And when the price to earnings ratio doesn't have any form of consistency, then it's really hard to draw conclusions from it. And when the price to earnings ratio is more consistent, like the JP Morgan price to earnings ratio we looked at, then it's much easier to draw conclusions about the business's current value. But again, taking a look at Berkshire's price to earnings ratio here, I'm not really going to get any conclusions or anything valuable from this chart. Now, the reason for Berkshire Hathaway's incredibly volatile earnings like this is because of a really silly accounting rule that took place in 2018. So what this new accounting rule, well, it's not really new anymore. It's about 4 years old now, almost 5. But this accounting rule that came into place basically said that businesses like Berkshire Hathaway have to report unrealized gains and losses on their investments every single quarter as either positive or towards their net income or against their net income, depending on what the value of their investments are doing. Basically what this means, because Berkshire Hathaway has an investment portfolio worth hundreds of billions of dollars, is that if their investment portfolio is up on the quarter, then they can report a large amount of net income. But if their investment portfolio is down on the quarter, then it means that they're going to report a very low amount of net income, which causes massive spikes to the price to earnings ratio like this. What this means ultimately is that Berkshire's price to earnings ratio is heavily reliant on what the value of their investment portfolio is doing from quarter to quarter to quarter. And in my opinion, this is kind of ridiculous, and it doesn't really show you a reflection of the profitability or the profit potential of the true underlying business. Now, also, I have a screenshot right here from Berkshire's own 2019 letter to shareholders. So this was written by Warren Buffett in the year 2019 when this accounting rule changed. And this says, Berkshire earned $81.4 billion in 2019, according to generally accepted accounting principles, commonly called GAAP. The components of that figure are $24 billion of operating earnings, $3.7 billion of realized capital gains, and $53.7 billion gain from an increase in the amount of net unrealized capital gains that exist in the stocks we hold. So there you have it. Warren Buffett is saying that $53.7 billion of their net income for the year was simply just unrealized gains or fluctuations in their investment value. Then he continues on that $53.7 billion gain requires comment. It resulted from a new GAAP rule imposed in 2018 that requires a company holding equity securities to include in the earnings the net change in unrealized gains and losses of those securities. As we stated in last year's letter, neither Charlie Munger, my partner in managing Berkshire, nor I agree with that rule. So Warren Buffett, the best investor who's ever lived, is literally saying that he does not agree with this rule either. And we've already kind of seen why. It's a little bit silly. And then he continues on, the adoption of the rule by the accounting profession, in fact, was a monumental shift in its own thinking. Before 2018, GAAP insisted, with an exception for companies whose business was to trade securities, that unrealized gains within a portfolio of stocks were never to be included in earnings, and unrealized losses were only included if they were deemed other than temporary, basically permanent losses to investments. Now, Berkshire must enshrine in each quarter's bottom line a key item of news for many investors, analysts, and commentators. Every up and down movement of the stocks it owns, however capricious those fluctuations may be. So you can see by his wording here that, again, he doesn't really agree with these rules. Continuing on, this says, Berkshire's 2018 and 2019 years glaringly illustrate the argument we have with this new rule. In 2018, a down year for the stock market, our net unrealized gains decreased by $20.6 billion, and we therefore reported GAAP earnings of only $4 billion. In 2019, rising stock prices increased net unrealized gains by the aforementioned $53.7 billion, pushing GAAP earnings to the $81.4 billion reported at the beginning of the letter. Those market gyrations led to a crazy 1,900% increase in GAAP earnings. So basically, year over year, because of what Berkshire Hathaway's investment portfolio was doing, they reported a 1,900% difference in the earnings just year over year. That is absolutely insane. And again, that kind of earnings fluctuation makes it really hard to gain any insight into how to value a business, especially like Berkshire Hathaway. Then he continues on, meanwhile, in what we call the real world, as opposed to accounting land, Berkshire Hathaway equity holdings averaged about $200 billion during those years, and the intrinsic value of those stocks we own steadily grew substantially throughout the period. Charlie and I urge you to focus on operating earnings, which were little changed in 2019, and to ignore both quarterly and annual gains or losses from investments, whether these are realized or unrealized. So once again, the best investor who's ever lived is quite literally telling us that we should ignore the fluctuations and market gyrations of unrealized losses in a portfolio, which basically means that we got to ignore the price to earnings ratio on Berkshire Hathaway in specific. Now, I also have a screenshot right here from Stock Unlock, and this is a visual representation of Berkshire Hathaway's net income or earnings over the years. So we can see right here in 2018, this was the down year for the stock market where their equity portfolio was down, and they had to report that negative $20 billion against earnings. Then we can see the next year, their earnings were up by over $80 billion because their equity portfolio was up in the stock market. Then it was down in 2020 because the stock market crash happened. Then it was up again in 2021. So this is just very, very volatile earnings solely based on what the stock prices are doing in the stock market. Now, what's also interesting is this doesn't just happen to Berkshire Hathaway. This also happens to stocks like Microsoft. This is one of the most followed stocks in the entire market. And if we take a look at Microsoft's price to earnings ratio throughout history, we can see that it has these massive spikes as well, where it spikes up to like 42, and then it spikes up again here to about 52, and then it drops all the way back down to 24 almost instantly. And this once again is because of unrealized gains or losses on investments, and it can also be due to non-cash items that the business has to either write off or put towards net income. So basically, net income or earnings for businesses includes a lot of non-cash gains or expenses that do not actually show you the true profitability of the business. So what can we do about this then? If the earnings of businesses can be incredibly volatile due to the fluctuations in asset values, then when can we trust the price to earnings ratios and how should we use them? The answer is that there's more price ratios that we as investors can use, such as the price to free cash flow ratio, price to operating cash flow, price to EBITDA, price to operating income, etc., etc. And these metrics can be used in certain situations on different kinds of businesses. And some businesses track certain metrics much better than others. For example, JP Morgan and the financials industry tend to have the price to earnings ratio be the absolute best metric to use. And then for financials, price to free cash flow ratios are trash. You should not use price to free cash flow ratios on financial businesses like banks or insurance companies. Whereas, price to free cash flow may work well on a stock like Microsoft or Google. So basically what I'm trying to say is that we cannot apply one price ratio to every single investment, and we kind of have to find the best price ratio or the best metric for every business that we are taking a look at. And depending on the business, there may be a better price ratio than another one. And it's not all just the same thing. which again is why Warren Buffett says that there is not one metric that you can take a look at on every single business and come to the conclusion that that business is cheap or expensive. Investing simply is just not that simple. So what we're going to do in our next video is go over all of the different price ratios, price to free cash flow, price to operating cash flow, price to earnings, and break them down even more so that we can see and explain exactly when to use every single price ratio. I have done a lot of research. I've been investing for about 5 years now, analyzing stocks every single day because I love it so much. And I have basically figured out when to use every price ratio and when it makes sense to use which price ratios. So again, in our next video, we are going to be going over all of that information. I'm going to be doing a presentation for you. So if you want to stick around and see that next video on when to use what price ratio and how to know which ratio to use, then make sure you subscribe to the channel and turn the notifications on so that you will be notified when that video posts. But that's going to wrap up this video. That is all for now. I hope you guys learned something about the price to earnings ratio, a little bit more on how to use it, its downfalls, its shortfalls, when you should not use it, etc. And if you enjoyed this video, then please remember to leave a like on it and also go and check out our Stock Unlock platform. That's a platform I use here on this channel, well, because it is our channel, but also because it is literally the best research and investment tool for all investors. And you can go and get a 14-day free trial, totally risk-free. You don't even need a credit card by heading over to Stock Unlock. Our mission over there is to turn you into a better, more educated, fundamental investor. And that's partly why we're making videos like this. So seriously, go and check out that platform. It is absolutely fantastic. Get your 14-day free trial and subscribe to the channel, turn on notifications, and I really hope to see you all again in our next video.